Hello investors, and welcome to my YouTube channel where I study the best investors and businesses from around the world. Without much more intro, let's get into today's main topic, SPACs. Have you heard about SPACs? You've probably seen at least a few articles talking about SPACs, right? So what is SPAC? SPAC, or Special Purpose Acquisition Company, is a company with no commercial operations that is formed strictly to raise capital through an initial public offering, or IPO, for the purpose of acquiring an existing company. SPACs have been around for decades, and it has been attracting investors in recent years. More than 50 SPACs were formed in 2020 in the US, which have raised over $20 billion. SPAC is also regarded as the fancy alternative to the IPO that's starting to make waves in financial markets. Despite having been around for decades, investors are now using SPACs more than ever before, bringing a number of notable firms to the public market, from Virgin Galactic to DraftKings to Tesla Challenger and Nikola. We've even started to see celebrities entering the space, with Jay-Z partnering with the cannabis back in California. Despite its recent popularity, however, the SPAC is not without its flaws. While it can benefit those who organize and carry out the offering, it has a history of disappointing investors. Therefore, before you decide to invest in one, you should probably know what it is, how it works, and why they're only now starting to take off. So let's go over this SPAC in today's video. When a company with an established business is looking to take its operations to the next level, its founders often consider taking it public. That is, selling all or a portion of their stake in the company to investors in the open market. Doing so can allow the company to more easily raise capital, since they can sell their shares to a wider population rather than relying on a few wealthy private investors, and as a result, the company may be able to achieve growth that was previously not possible. Conventionally, to go public, a company would need to go through what's called an initial public offering, or IPO, making sure that they meet all regulatory requirements, and eventually they're building their shares on an exchange. The problem is that the IPO process is a pretty painful one for the founders. Companies need to file mountains of paperwork with regulatory bodies, go on lengthy roadshows to court institutional investors, and pay a buttload of money to invest in bankers to help them through the process. Underwriting fees alone often take anywhere from 3 to 7% of the raised proceeds, sometimes even more. But what if you could take a company public without spending all of your time filing paperwork, marketing your business, and best of all, without paying a fortune to those investment bankers? Enter the SPAC, or Special Purpose Acquisition Company. Here's the basic idea. A manager with expertise in a particular field or industry will set up a shell company with no assets and no core operation. This is an SPAC, and the manager, known as the sponsor, will then go around and try and convince public investors to invest in this new company. Now, the public investors are well aware that the SPAC doesn't have much going on, if anything, but the manager will promise them that if they fund the company, they'll go out and they'll find a private firm to acquire with the proceeds raised. If they are successful in garnering interest, the sponsors will then IPO the SPAC. With no assets, it's much cheaper and more straightforward process than the IPO for a proper company. From there, the SPAC will approach the private company they want to take public and offer to buy them with the investor funds raised. Sometimes it's also supplemented with debt. If the private company agrees and the investors approve it, then they will merge with the SPAC and take its place in the public market. Bam! You've now taken a private company public without going through the IPO process. While a sponsor may have a particular target company in mind when they're setting up the SPAC initially, one of the crazy things about this vehicle is that it's often not disclosed to investors who they plan on purchasing, since doing so would complicate the IPO process. In other words, investors who purchase SPAC shares don't actually know where their money is going to end up. This is why SPACs are often referred to as blank check companies. Investors are more or less funding an unknown initiative, putting their faith behind the skills of the SPAC sponsor to find an attractive acquisition target on their behalf. Another point worth highlighting about the SPAC on the technical side is that they're often issued with a stock as well as a partial warrant to their initial investors. A warrant is simply a right to buy stock at some point in the future with a predetermined price. Most SPAC shares start off at a price of $10 per share, and a warrant will often let you buy more shares for $11.50 per share. Partial warrant simply means that you need more than one share, or perhaps two or three, to purchase one additional shares through the warrant. This warrant is added as an incentive to the initial investors. If the SPAC announces an attractive acquisition and shoots up in price, the incumbent investors can exercise their warrants by buying shares at $11.50, which would be lower than the market price. So that's the SPAC in a nutshell, and it's something that's been around for decades, as we previously mentioned, but it's recently surged in popularity. Over $41 billion has been raised by SPACs, more than the last 10 years combined. Why the sudden interest? Well, it comes down to a few things. Number one, in a year where companies have seen their stock prices double and triple after going public, SPACs arguably offer private companies a better method for capturing this value. Because when you think about it, a stock rising after its debut sort of represents a lost opportunity and value for the owners. Since that growth represents a higher price they could have sold their initial shares for. Now they're missing out. The problem is that with an IPO, it's usually unclear what the price will be until further down the process. Not to mention that shares are often first sold at a discount to the institutional investors who buy the first batch, largely thanks to their massive bargaining power. With the SPAC, however, the private owners of the company are provided a simple fixed dollar offer, and they can either accept, turn down, or negotiate, meaning that they can more easily capture the value of their company through the SPAC, all the while skipping the massive underwriting fees that they would normally be paying to investment bankers. Number two, with the lockdown currently ravaging the economy, the SPAC is often seen as a less risky route for private owners. It's unclear whether there will still be a demand for a new IPO 6 months from now, so many companies may be more comfortable opting for faster, lower-cost SPACs than starting the lengthy and costly IPO process, only to find that interest may have possibly dried up by the time that they finally hit the stock exchange. But while some are coming to claim that the SPAC is here to replace an old and out-of-touch IPO process, this alternative is not without its flaws. So before you consider buying an SPAC, make sure that you consider the following points. While SPAC may have saved the private owners some money, they can still cost investors quite a bit of cash. Sponsors that set up a vehicle often take a large chunk of the company's shares, typically 20%, as a promotion for setting everything up. In other words, sponsors treat themselves to a fifth of the company while paying only a nominal amount for this ownership. On a $100 million company, that's effectively $20 million compensation package paid by other investors. Many stocks have built-in mechanisms whereby the funds raised must be returned to the investors if the sponsor is unable to acquire a company within 2 years typically. Now, this function makes sense and is there to protect investors and ensure that they see their money put to use rather than sitting around doing nothing. But it can incentivize the sponsor to move forward with an unattractive acquisition. After all, if a sponsor can't find an appropriate acquisition target, they may go for a much less attractive company just to make sure that they get their compensation. Even if the company ends up dying, they get more than they would have received if no deal went through. While investors do get to vote on these acquisitions, they've already put their faith behind the sponsor buying the SPAC in the first place, so they may be inclined to defer their judgment to whatever the manager decides. It's important to note that the SPAC doesn't have a great historical track record. By bypassing many of the regulatory and legal hurdles associated with standard IPOs, SPACs have attracted many dodgy companies over the years. We've seen instances of SPACs acquiring private firms that have been fabricating aspects of their business, leading to large losses for investors later on down the road. On top of this, the SPAC track record for 2020 has been less than optimal. According to Renaissance Capital, SPAC mergers achieve an average return of 13.1% from January 1st to July 21st of 2020, which is a pretty good return. But excluding the big names of DraftKings and Nikola, that average falls down to negative 10.5% compared to an IPO average of 6.5%. So maybe the SPAC isn't as perfect a solution as it's been made out to be by some, but it's nonetheless something that we may see more of moving forward. So as an investor, it's important to understand the key features and drawbacks of the vehicle. There will likely be both very successful and very unfortunate SPACs in the future. So as with any other investment, make sure that you do your due diligence and consider all the benefits and costs of you before you consider buying one. Hopefully SPACs start to garner a better and more trustworthy reputation, but in the meantime, be careful with them. While taking a company to market quickly certainly has its pros for the founders, it can be a detriment to the investors if corners are cut in the process. So, thank you for tuning in today. I hope that you've learned a little bit about the pros and cons of SPAC investment. Please hit the like button and use the comment box if you have any questions regarding SPACs. I'll be sure to attend to your questions. If you enjoy the information shared, comment and subscribe to the channel if you haven't done so already. Thank you once again, and I'll see you in the next video. Until then, happy investing.